Natasha, head of global commodities research and strategy at JPMorgan. Thank you so much for being here, Natasha. So is this a sign that investors should be buying commodities right now, given what we're seeing on the geopolitical and inflation front?
Leslie, yes, thank you for having me. You're absolutely correct. So clearly the geopolitical escalation over the last couple of days has materially increased the risks of further aggravating commodity markets imbalances. This is especially considering Russian market size in most of the commodities. Yes, Russia produces about 10% of the global oil, 20% market share in natural gas prices. You're absolutely correct. 30% combined Ukraine and Russia in the global wheat production. And then in the case of metals, it's about 10 to 15%, if we exclude China out of that. So it's a very, very significant imprint on the commodities markets. And this is all against the backdrop of depleting inventories, which pretty much gives us very, very little buffer in terms of any extra inventories. If there is less supply or demand comes a little bit stronger. So because of that, we can definitely make a case for non-linear increase in the prices. Indeed, if this, the situation escalates further. So being long commodities makes all the sense in the current environment.
Can you help break down how different types of sanctions actually affect energy prices from here? The U.S. so far has not necessarily targeted the entirety of Russian energy exports, but there is a spillover effect from financial sanctions and some of the pipeline sanctions as well. And what's the potential for Russian retaliatory sanctions at this point in time?
Yes, Leslie, you're correct. So the current phase of sanctions we're experiencing is that it's non-energy trade and financial links. So from that perspective, I think both U.S. administration and the European administration are very explicit that they want to carve energy out of the package because the whole purpose of smart sanctions is that they are targeting a particular outcome and they want to spare the Russian citizens in general and definitely the consumers in the European Union and in US. Because of that, energy is carved out. But in general, the way to think about that, it's not the impact of the sanctions on Russia, but it's how Russia will respond to those sanctions. And in general, we do believe that the market participants could begin pricing a probability that actually Russia can retaliate. Yes, and the easiest way for Russia to retaliate, it's through constraining the export volumes of energy where Russia is absolutely dominant. So in general, Russia has been, not in general, historically, Russia has always been a very reliable supplier of energy, of oil and gas. And even at the height of the Cold War, during the Cuban Missile Crisis, Russia actually continued supplying volumes. And there was never a scenario when geopolitics actually interfered with economics. But at the same time, especially, after the Monday speech, which I began changing my opinion very rapidly, I would have to say to admit is that there could be case made that the market participants as well will begin changing their opinion that maybe the situation has changed and Russia indeed might retaliate through energy.